There's a canary in the coal mine of the financial system, and its song just stopped. The reverse repo market, a critical piece of financial plumbing where banks and money market funds park trillions in cash overnight with the Federal Reserve, has just collapsed. This isn't a minor tremor, it's a seismic shockwave right at the foundation of the system. And right now, in 2024, the signs are pointing to a cascade failure, following a script that has played out before in financial crises, stage by stage, signal by signal. We're watching a slow-motion implosion, and most people don't even know what the reverse repo market is, let alone that it's flashing red alert. For years, this market has been the bedrock of short-term liquidity. It was the ultimate safe haven, the place where the biggest financial players, banks, institutional investors, and especially money market funds could stash their excess cash and earn a risk-free return directly from the Fed. It was considered the absolute bottom tier of risk, safer than any bank deposit, safer than any treasury bill. A sudden, catastrophic collapse in this market is a dagger to the heart of that confidence. It signals that even the most secure, most basic cash vehicles are now under extreme stress, undermining the very idea of a risk-free asset in our financial system. The ground beneath our feet, which we all assumed was solid rock, is turning out to be quicksand. The drivers behind this collapse are a toxic cocktail of high interest rates and the Federal Reserve's own policy shifts. As the Fed aggressively hiked rates to combat inflation, it inadvertently made other short-term investments, like treasury bills, more attractive than the reverse repo facility. This caused a massive coordinated withdrawal of funds as institutions chased higher yields elsewhere. This isn't just a simple reallocation of capital, it's a frantic exodus. The predictable, steady flow of cash that stabilized the system has reversed course, draining the reservoir of emergency liquidity at an alarming rate. The immediate consequence is a severe tightening of liquidity across the entire system. When the primary source of overnight cash dries up, it means banks and investment funds could suddenly find themselves struggling to meet their most basic short-term obligations. Think of it like the water pressure in a city dropping to zero. Faucets run dry and the system can no longer function. This isn't a theoretical risk. We are watching in real time as the institutions we trust with our savings are being cut off from their primary emergency cash source, raising the terrifying possibility of a freeze in short-term lending. Nowhere is this danger more acute than in money market funds, the bedrock of many Americans' savings. These funds, which collectively hold trillions of dollars in retail and institutional cash, have leaned heavily on the reverse repo market for both stability and yield. They sold their investors on the promise of absolute safety and immediate liquidity, a promise underwritten by their ability to park cash with the Fed. With that pillar now gone, these funds are exposed to a level of risk that most of their investors never imagined and were never warned about. They are now navigating a minefield without a map. The risk now shifts directly to the investors in those funds. A panic could easily set in. If even a fraction of investors decide to pull their money out, a perfectly rational decision given the circumstances, these funds could face a tidal wave of redemptions. To meet those redemptions, they would be forced into a fire sale of their assets, dumping bonds and other securities onto an already fragile market. This would not only trigger losses for their remaining investors, but could also unleash a contagion effect, destabilizing the entire short-term lending ecosystem and creating a doom loop of selling and panic. This collapse lays bare the incredible fragility of our financial infrastructure, a fragility engineered by more than a decade of the Federal Reserve's extraordinary interventions. Years of zero interest rate policies and quantitative easing created a system addicted to cheap, easy money. The reverse repo facility became a pressure release valve for the trillions in excess liquidity the Fed pumped into the economy. Now that the Fed is trying to reverse course, the system is breaking in predictable, yet terrifying ways. We are discovering that the very tools used to save the economy have planted the seeds of its next potential crisis. Corporations and large institutional investors who depend on overnight markets to manage their daily cash flow are now in a precarious position. They can no longer rely on this once stable source of liquidity. They will be forced to scramble for alternatives, driving up short-term borrowing costs for everyone. This isn't just a problem for Wall Street, it's a problem for Main Street. When the cost of short-term funding for major corporations spikes, those costs are inevitably passed on to consumers, and it puts a brake on hiring and investment. The Federal Reserve is now cornered. They may be forced to intervene aggressively to stabilize the market, just as they did during the banking crisis of 2023. Such an intervention would be an admission of failure, a signal that their policies have backfired spectacularly. They would have to flood the system with liquidity once again, effectively undoing their fight against inflation and further distorting the market. It's a choice between two poisons: risk a full-blown financial meltdown or sacrifice the long-term health of the currency to paper over the cracks one more time. History shows us that dysfunction in the repo market is often the first tremor before a major earthquake. This obscure corner of the financial world underpins the operations of money markets and sets the baseline for lending rates across the economy. A failure here doesn't stay contained. It radiates outward, threatening the stability of the entire credit system. The 2008 financial crisis and the 2019 repo spike were both preceded by warning signs, just like the ones we're seeing today. We are ignoring these signals at our peril. The securities that were once the gold standard of safety, treasury and agency bonds, are now facing extreme price volatility. These are the very instruments used as collateral in the reverse repo market. As demand for them collapses, their value could become erratic. The market for the world's safest assets is now flashing warning signs, a development that should send a chill down the spine of every investor and policymaker. When trust in government debt begins to erode, the final pillar of financial stability is at risk. All eyes are now on the shadow banking system. Hedge funds, private credit funds, and other leveraged players are watching this breakdown with a mix of fear and predatory opportunism. A failure in the core plumbing of the financial system can create a cascade of defaults that ripples through the highly leveraged, opaque world of shadow credit. These entities are interconnected in ways we don't fully understand, and a crisis that starts in the repo market could quickly metastasize into a full-blown credit crunch. For the average person, the most immediate danger lies in the assumption that their money market fund is as safe as cash in a bank. It is not. Investors who believe their principal is completely protected could be in for a rude awakening. If these funds break the buck, meaning their net asset value, NAV, falls below $1 per share due to forced asset sales or defaults, it could trigger a panic that makes the 2008 crisis look tame. The implicit guarantee of safety is being tested, and the system may not withstand the pressure. This is the ultimate warning signal for the broader financial system. It demonstrates that in today's high-rate, tightly regulated, and artificially managed environment, nothing is truly safe. The very mechanisms designed to prevent risk have, in fact, concentrated it in a few critical failure points. The collapse of the reverse repo market is the first of these points to give way, exposing a structural rot that goes to the very core of modern finance. The balance sheets of the nation's biggest banks are now under a microscope. They are facing a potential spike in their own funding costs, coming at a time when they are already under pressure from unrealized losses on their bond portfolios. If the repo market instability spreads, it could trigger a funding crisis for banks that are far more vulnerable than regulators have led us to believe. The stage is set for a repeat of the 2023 regional banking crisis, but this time on a potentially much larger scale. What we are witnessing is not just a temporary market dislocation. It is the exposure of profound structural weaknesses in the plumbing that supports trillions of dollars in short-term lending across the globe. For decades, we built a global financial system on a series of assumptions: that liquidity would always be available, that central banks could control everything, that certain assets were risk-free. One by one, those assumptions are being proven false. Regulators and the Federal Reserve are now facing an impossible choice. Do they intervene with overwhelming force to stabilize the market, further entrenching moral hazard and risking another inflationary spiral? Or do they step back and let the market's inefficiencies correct themselves, risking a full-blown panic and a systemic collapse? There are no good options left. They are trapped by the consequences of their own past actions. If you are an investor in a money market fund, you must now reconsider your exposure to risk. The promise of stability is no longer guaranteed. The core assumption that your cash-equivalent investment is safe from market turmoil has been shattered. You are being paid a small yield to take on a potentially catastrophic level of systemic risk, a risk you were likely never told you were taking. And so, we are left with the critical question: the one that will define the next chapter of our economy. Is this just a temporary blip in the complex world of financial plumbing, a technical glitch that will soon be forgotten? Or is this the first domino to fall, the unmistakable sign of a broader, systemic shock that is about to ripple through the entire financial system and directly impact the savings and security of every single American? The evidence is piling up, and the answer is becoming clearer every day. We aren't approaching a crisis. We're deep inside it, and it's happening faster than anyone wants to admit.